Good afternoon, everybody. I must say that I'm usually hated both by English speakers and German speakers because I speak so fast that it's impossible to translate and it's impossible to grasp very often even in English. So if I speak too fast, just make me a sign of some kind. So when I was presented with the question of whom does digital capitalism belong, I was a bit ambiguous, I must say, in responding to it, and my initial inclination was to actually say that the question is ill-posed, in that the separation between digital capitalism on the one hand, and for example, highly financialized capitalism, would be a very hard and untenable proposition to defend. Just look at one piece of statistics. The largest trader of private corporate bonds in the world is none other than Apple. Apple has amassed $180 billion worth of privately issued corporate bonds. You never think of Apple as a financial company. Nonetheless, they have their own financial trading fund, situated in Nevada. So it would be very hard to avoid this elephant in the room, given that the company that trades most in private bonds happens to be a technological company. At the same time, if you look at the money and at the funds that is now flowing into the technology industry, and I'm talking about both public markets, so if you look at the way in which the stock of these companies are traded, but I'm also talking about private investments into startups and companies that are not yet listed on public markets, you would discover that this money also primarily comes now from financial institutions, most of all sovereign wealth funds. So if you look at, for example, some of the largest, if you look at who are some of the largest owners, right, of the technology industry, big firms like Google, Facebook, Apple, and Microsoft, the listed ones, you'll see that those are primarily sovereign wealth funds of countries like Norway. Actually, Norway happens to be the country that owns and most exposed to the technology industry in the United States. And if you look at the valuations of these firms on the stock markets, you would also discover that many Norwegians have benefited quite enormously from having their sovereign wealth fund own so much stock in those firms. Those of you who haven't been following the market closely, let me give you another piece of statistics. So if you look at the total increase in value, in stock value, of just 5 American firms, Apple, Microsoft, Google, Amazon, and Facebook, right? Their total value from January 1st of this year has increased by an amount roughly equal to $950 billion. Right? That's almost $1 trillion increase in the value of those firms. Right? That's, by the way, bigger than the GDP of Norway, Denmark, and Finland combined. Right? That happened in the last 10 months, essentially, from January 1st. It's not just the United States. You see similar trends happening in China, with just 2 big firms, Alibaba and Tencent, have added something like $450 billion to their valuations. Right? This is quite big, I must confess. But it's not just that. Virtually every single sovereign wealth fund on the planet is now thinking very hard how they can get a piece of the pile, how they can set up an office in Silicon Valley, how they can find a way to invest not just in established companies through the stock markets, but also into unlisted startups through some kind of private stakes. And this explains, for example, why we see giant pools of money, literally giant pools of money. Think about a technology fund that was launched last year by a Japanese firm called SoftBank, right, which is one of the largest Japanese firms in the world. They have launched a so-called Vision Fund, where they have raised $100 billion to invest in startups. They didn't raise it just from their own funds, even though they have contributed quite a bit. They have raised it also from the funds of governments like Saudi Arabia, Malaysia, Singapore, and so forth. So you have a lot of government money, more or less, flowing into such funds. Now they're about to set up another fund, which will be worth $200 billion. The reason why I'm giving you all these figures is because without getting this bigger picture of where the money goes and where it comes from, it's impossible to understand why these firms are valued as high as they are. So SoftBank, this technology fund that I've mentioned, is about to invest possibly $10 billion into Uber. And this is not a minor investment. This is more than the research and development budget of many countries. They're about to dump essentially $10 billion onto a firm like Uber and let Uber do essentially whatever they want. They can expand into 100 more countries. They can accelerate their work on self-driving cars. You can do a lot of things with $10 billion, right? But the reality is that that money comes from global financial investors, many of them representing governments actually through sovereign wealth funds, hungry for a return in a global economy that no longer guarantees a return that many of those pension funds and sovereign wealth funds expend. And this explains why Uber is valued at more than $60 billion. That explains why Airbnb is valued roughly at $40–50 billion. And that explains why it's so easy to attract such huge investments without even having to go to the capital markets. So more and more startups now actually say, we don't care about public markets, we don't need to do an IPO. There is enough money flowing into our direction from the likes of SoftBank or the government of Saudi Arabia, or the likes of Goldman Sachs, which also invested in Uber, to essentially keep on going without having to list on the stock markets altogether. It's quite a remarkable feature of contemporary capitalism, that firms themselves are no longer interested in actually going public anymore. Now, I can go on with a lot of these figures. If you look at China, you'll see that the situation is even more fascinating because they have formed a lot of joint venture capital funds with other governments. So Chinese have their own venture capital fund with the Russians, and they invest in companies that are overlooked by many other investors. So for example, one of the most promising startups now doing facial recognition, and they claim to be doing it better than Google and Facebook and Microsoft, is a startup that essentially attracted money from the joint venture capital fund set up by the Chinese government together with the Russian government. Right, so there is a lot of government activity which I'm afraid to say I don't really see matched or replicated at the European level. Right? Europe is not really, except maybe Norway, which invests in these things passively, by investing into already listed firms. There is very little action of similar kind happening in our part of the world, so to say. Now, having outlined this intermingling, if you will, of financial capitalism and technological capitalism, driven, as I've said, by the lack of returns that you would get from productive investment into other domains and other industries, right? You can see that there is something about digital capitalism that avoids and escapes our ability to pin it down and understand it. And I would argue that there are three deficiencies in our thinking about it. And if I have enough time in the remaining minutes, I will explain every single one of those three deficiencies. I'll list you in case I will not have time, so at least you know what they are. Deficiency number one, we are very quick to present and imagine digital capitalism as something recent, as something unique, as something exceptional, and as something that is driven primarily by technological change. Right? It's driven by internal developments of the technological revolution, and it's something that more or less emerged due to acceleration of this technological revolution in the last decade or the last 15 or 20 years. I would radically challenge that view. And I would argue that the only way for us to understand the rapid acceleration of digitization and the emergence of these global platforms like Uber and Airbnb, but also Facebook, that require very little capital investment, but manage to be present globally and extract value from all corners of the world, this is something that has to be traced back to two previous, so to say, crises of capitalism. One of the early 1970s, a crisis of profitability, and the crisis of 2007, 2008, which, of course, we tend to think of as a financial crisis driven primarily by subprime mortgages and related securities, but I would argue that the story there is a bit more complicated. So I will unpack this connection. Ultimately, what I'm arguing for is that there is a longer view and a longer genealogy, if you will, of digital capitalism, that if you situate it, right, in a much earlier period, if you start from the 1970s onwards, and you try to understand how on earth we arrived to where we are with Uber and Airbnb, you'll get also a much more productive view on how you can actually do still something about this problem. Problem number two, and the deficiency number two in our thinking about digital capitalism, is that we have a very hard time periodizing, so to say, its own history. Right? We tend to think of it as something driven by trends that are permanent. We think, for example, in the case of firms like Google or firms like Facebook, that ultimately it's driven by advertising, and advertising that then subsidizes a lot of free services, and we take that for granted, that more or less is the business model that will continue underpinning their expansion, their growth, and their productive activity. I would challenge that view as well. And I would argue that we need to be able to periodize digital capitalism better and to identify what exactly are the dominant features of what stage of digital capitalism that is going to then propel its future. And I will explain what exactly I have in mind, but let me give you a hint. I don't think that advertising subsidized and advertising-driven expansion of the digital platforms is here to stay. I do think that we'll see a shift to a very different model that will be less and less driven by advertising and the subsidies it creates, and much more and more so driven by artificial intelligence and the services built around it, which will not be free and subsidized services. But I will unpack that as I go on. And the last point that I would like to make, again, I'm just summarizing them, so let's see how we do on time, is that we have not been thinking ambitiously enough. We need to have more structural level interventions that go beyond just banning those firms or trying to think about new laws in which we can better monitor the algorithms or enforce better privacy protections on them and so forth. I think we need a much more ambitious type of intervention, much more ambitious type of thinking that will tackle the question of data ownership and that will tackle the question of who is going to own the artificial intelligence services that are essentially built with that data. Right? So let me, in the remaining time, let me talk about all three of those deficiencies in our thinking. So deficiency number one, I think, has to do with our inability to situate digital capitalism in the crisis of contemporary capitalism in all its dimensions, not just in its digital one. If anything, the digital dimension of contemporary capitalism is presented as a savior, as a solution to the problems that have been not adequately tackled by the previous solutions. And I would argue that those previous solutions have been many, but the three in particular can explain our contemporary predicament. And you probably are well aware what those solutions are. So as capitalism enters into its profound crisis of profitability in the early 1970s, and as the profit rates decline, I'm not going to enter into the debate why that happened, because that might derail our entire afternoon. But nonetheless, as it seeks to address its own crisis of profitability, there are basically several options that are tried and that fix the problem in a very short term. In some case, maybe it works for 20 or 30 years, but then those solutions start producing their own rather negative consequences, which then produce their own systemic crisis and whatnot. And of course, the solutions I have in mind primarily are financialization, right, where we try to move away from an economy based primarily on manufacturing and production to an economy dominated by the financial sector, which has all sorts of consequences, including, by the way, tying the well-being of many workers and of many citizens to financial assets, whether those are stocks or bonds or whether those are their houses, right? You clearly see a shift towards what many sociologists and economists call asset-based welfare, right, which actually becomes a policy proposition for many governments and many forces, including many social democratic ones, including in places like the United Kingdom, for example, with New Labour, where the idea is that as the welfare state crumbles or faces difficulties, we can compensate people with either more investment that they themselves would make in the stock markets, and the interest rates will be quite conducive to them earning a good return on those investments, or by encouraging them to buy houses. Germany somewhat escaped and avoided the problem with the housing, but most European states, and certainly the United States, went down that path, which explains to you how we end up with something like Airbnb being seen by many people who are otherwise in the middle class or lower middle class and who happen to own an apartment as a potential replacement of their traditional institutions of the welfare state. For many people in Southern Europe, if you go to Rome, if you go to Barcelona, if you go to Lisbon, for many of them, their house and the ability to put their house on Airbnb is actually the only lifeline left to generate stable income, right? And I think we should not underestimate just how much this has been contributing, essentially, to helping people survive on greatly reduced income, which had to do with greatly reduced wages, right? And I would argue that quite a lot of other elements of the digital economy can be explained that way as well, that the greater financialization of the economy had also led to more and more ways through which people try to more or less make their ends meet with the help of digital technology, right? And clearly it has also introduced quite a lot of savings, right? So if you look at something like Uber, if you look at something like many other of those firms that I have mentioned, you will see that the reduced costs, right, that they offer do allow people to enjoy quite a lot of services without paying their full cost. Right? So if you look at Uber, you can either make the case that is greatly subsidized by their smarter and clever use of sensors and algorithms, which produces immense efficiency and savings, which then actually allows people to save on what it is that they pay to Uber, or you can argue that essentially it is subsidized by the governments of Saudi Arabia and Goldman Sachs, who by investing in Uber expect to get a nice return at some point, but temporarily they're much more interested in crushing the competition. And by crushing the competition, you also imply reducing the rates that you charge, which also explains why Uber is losing something like $1 billion in North America alone every year. Right? The only reason why they can lose so much money and still offer very cheap services to people, which people actually enjoy because they're so cheap, is precisely because they're sitting on so much cash coming from all these highly financialized institutions and institutional investors. Right? There is much more to be said about it. And I think ultimately the kind of argument I would like to make is that the clever connection, right, of this strand of kind of digitally produced economy and digitally produced society has allowed us to connect it to advertising, which reduced the cost of living even more. I mean, think about how much we are undercounting, right, the actual value created by many of these platforms that operate our email, that operate our search, that operate our maps, that operate our video, our entire digital infrastructure, if you look just at sort of consumer-facing services, is entirely subsidized and underwritten by a bunch of firms that have managed to tie the provision of those services to the provision of advertising that they then sell to third parties. So think about immense value that is not paid by anybody. It's not paid for by citizens who do not have to pay for using Google, who do not have to pay for using search and any of the basic services that everybody uses on a daily basis. Think about how much money businesses are saving for not having to pay for much of that infrastructure. Governments are not paying for that either, so the question then becomes who pays for all those goodies? And the answer is obvious. Advertisers pay for those goodies, and advertisers pay for those goodies because so far the advertising system has been working, but we are not counting that value at all. Right? There was a study which you can quibble about its methodology, but there was a study that was released by MIT earlier this year that basically asked people how much they would need to get paid not to be using Google and YouTube and Google Maps for a year. Right? So how much you would need to get paid not to use any of those three services. And the average number that they arrived at was something around 17,000, 18,000 euro. 17, 18, yeah? Which, again, you might argue is kind of a first world problem, and of course there will be a lot of people in the developing world who would refuse using those services for much less, but I think it does point to the fact that much of our digital economy has essentially been underwritten by this advertising business, right? And nobody has had to pay for it, and we have kind of pretended not to look for the source of value that has been created. If you start pricing that data fairly, you will see that either we'll have to pay for those services, which we will not be able to afford, given how much indebted many Europeans and Americans already are, or the governments will have to pay for it, which will, of course, also then create a debt burden and whatnot. That model, however, is not going to last, right? And I will tell you why. The dominant assumption, right, that many of us have had about the digital economy is that this advertising-led and advertising-subsidized expansion will continue forever. It's a very vulnerable model. Right? You have to understand that a lot of those firms might actually be disrupted by a very clever ad blocker. They might be disrupted by the global economy not growing as fast as it did. It might be disrupted by the Chinese government deciding to just simply ban all of its firms from advertising on Facebook and Google, which they, by the way, are still allowed to do, even though those services are not available in China. There are all sorts of things which the digital industry itself does not control when it comes to advertising. On the other hand, the underlying model, right, behind advertising, which involved massive amounts of data collected from all of us in order to offer better and more personalized advertising, has allowed those firms to think about a transition, right, to another industry, which is all about offering services that have been built with the help of that data. The primary service here, of course, is artificial intelligence, which can be offered for a fee to all the other sectors of the economy and society at large. So if you look across the board, from Amazon to Google to Facebook to Microsoft, yes, we can say that all of them are digital monopolies and they monopolize their own sectors, but they all compete in one dimension. And it does have to do with this services based on AI in one way or another. Like right now, it involves quite a lot of cloud computing, but increasingly it involves a lot of artificial intelligence services. Let me give you an example of what I have in mind. So Google, by more or less drawing onto its own AI systems, now has managed to build a system which saves them something like 40% of costs on energy. Right? So they've managed to cut their own energy costs by 40% by essentially drawing on their own in-house built AI system. Right? With that, you can see that they actually do have a very valuable product and service, which they can start selling to the rest of the industry, and the rest of the industry, including many other sectors, have no way to compete, given that they do not have access to the same AI. The same story you can see in many other domains, from self-driving cars, where, again, much progress has been made due to the ability of firms like Google to do image recognition and object recognition better than anyone else. Why on earth can they do better image recognition? Partly because all of us, in one way or another, are helping to improve and hone their image recognition skills by using their products on a daily basis. And it's not just a matter of abstraction. On a very practical level, if you use, for example, a service like Google Scholar, you will sooner or later see that Google would like you to prove that you're not a robot. Right? So if you use it too much, Google will show you a little thing and ask you to prove you're not a robot. And what they do in the last few years to prove that you're not a robot, they ask you to look at a photo and select, for example, all the cars that you see in the photo, or select all the street lights that you see in the photo, or select all the front kind of shop fronts that you see in the photo. All of that is geared towards deploying all of us to training their algorithms to recognize objects. Like, it's simple. You can go and place 20 search requests on Google Scholar within a minute, and you will see that Google will ask you to do precisely that task. Right? It's a very simple example, but it's an example that I think clarifies quite well how these digital systems, driven by sensors and algorithms and by optimization criteria that we ourselves do not really understand, do end up giving these firms a lead and an advantage above everybody else. And if you look at how much money they make with these digital services, you will discover that they have much higher profit margins on offering such services than they do on their core business, which in the case of Google is advertising, and in the case of Amazon, for example, is sales, right? Amazon's profit margins on cloud computing and web services, which is a business that Amazon runs. If you need to classify 5,000 images into images that have a car in them and images that have a person in them, you pay Amazon a fee, and for a small fee for each image, Amazon will do that job for you. Right? Which is a service they build for businesses. They have 50 of those services or more. Right? They have far higher profit margins on those than they have on advertising. And I would argue that this is the kind of future that we are increasingly going to face. And we have to be able, as I've said, to do a much better periodization of digital capitalism and to understand that it might as well be true that we are exiting an era that was primarily tied to advertising, and in retrospect might not actually be all that bad, because there was quite a lot of free lunch to be going around, as long as you allowed yourself to be colonized by these firms learning everything about you, to a stage that will be much more, first of all, fees-driven, where somebody will have to pay. So, when Google makes a deal with the National Health Service in the United Kingdom, in order to help the United Kingdom government and the NHS essentially to identify early signs of kidney disease in the patients of the NHS. We know why it's done, because NHS is out of money. We can, of course, through a much longer kind of approach I outlined at the beginning, try to understand why NHS is out of money and why they're so keen to collaborate with Google, but that's the reality, right? And the reality is that for the first few years of publicity stints, Google is going to do those things for free, because ultimately it generates good publicity. You can forget about them doing it for free forever. Once your healthcare system depends on AI offered by those firms to optimize its own limited budget and its own limited resources, you'll have to pay them. Right? It's a very simple model driven by this paradigm, this kind of paradigm shift to the servitization, if you will, that many enterprises before Google and before Amazon underwent in 1970s and 1980s. Right? We all know that IBM no longer makes a lot of hardware, if any at all. All they do is sell services, which explains to you how things like the smart city, for example, which essentially is a bunch of services offered by these big firms, packaged under a label and a brand of a city, how they enter our public debate and how they enter our municipalities. Right? So again, bringing this kind of two strands together, and I'm about to finish with the third one, we will not be able to understand why digital capitalism does what it does without starting with a somewhat longer perspective, understanding what has been driving the profitability of many of those firms, for example, like IBM that I have mentioned, without understanding how the liberation of so much financial capital resulted in so much money flowing towards them, and without understanding how the overall background of the financial crisis has left so many municipalities and public agencies and governments broke or without money, and thus looking for quick fixes that they can sell to their own publics under the label of digital innovation. Right? This is what a lot of municipalities do now, for example, when they contract for smart city services. And secondly, as I've said, we need to better periodize digital capitalism to understand that advertising-driven utopia will not be lasting forever, and if it's not lasting forever, we have to understand who's going to pay for it. And it will be us. And the last point I would like to make in wrapping up is that we, again, need to learn to think bigger. We need to learn to think beyond just privacy concerns, which are important, but they do not cover the entirety of what I've been saying. We need to be able to learn beyond just banning those firms, because again, in the case of Airbnb, for example, in Southern Europe, they are a lifeline to a lot of people who do not have any other sources of income. If we want to make them less dependent on Airbnb as a source of their annual income, we have to create jobs for them. We cannot just expect our cities to be banning those platforms while the nation state at the national level just does nothing. Right? So again, all of those problems have to be situated properly politically. Last point I would like to make is that if we go beyond just the discussion of privacy and just banning of those firms, what is it that we can do? I think this is where much depends on what kind of landscape technologically and politically you see ahead of you. If you see a landscape that will result in 4 American firms, hopefully maybe 5 American firms, and 4 Chinese firms dominating the entire AI, artificial intelligence landscape, then the picture looks rather gloom. I mean, just think about Amazon last year has spent $13 billion on R&D, right? Google spends roughly 11, 12 billion dollars on R&D. Amazon, $13 billion. This is a lot of money. Alibaba just promised to spend 10 billion on developing just artificial intelligence, which a big Chinese firm. Right? Those are big figures. They all know that competition is going to happen at that level. It's going to happen at the level of AI and prediction. And this is where having a robust computing infrastructure is good and helpful, but also having tons of data is also very helpful, because without data, you won't build good AI. This is what builds deep learning and machine learning now. It's the data. It's not clever computer scientists working in a garage. You need those scientists, but you also need the data. If that's the landscape that we are entering, the question should be, is there any way to resist this corporatization, if you will, of everything by means of AI? And if there is that path, how do you do that? What is the right ownership regime for data? Should we be thinking about collective rights to owning data? Should we be thinking about ways in which our municipalities, instead of surrendering all this data they generate to providers of smart city services, or to companies like Google, by the way, which are also now building their own digital cities. They've just announced they're building an entire quarter of Toronto. So in Toronto, Google is going to be responsible for garbage collection, right? And for warming up the pavements so that people from Toronto can take their bicycles to work. It's going to be run by Google, right? It's a project that the municipality of Toronto signed off to Google, right? I'm not speculating here about some hypothetical future. This is happening now. Right? So clearly there'll be a lot of data generated through all of those systems. And the question should be, who's going to own it, A, and B, will the collection of that data by actors other than these big companies be tied to a somewhat broader agenda for creating robust artificial intelligence systems that will be capable of at least defending us somewhat or helping us resist if you will, the intrusion of these firms into our economy. And this is where, in our society at large, and this is where I do not really see a lot of progress in Europe, to be honest. I don't see this question of AI being understood. I don't see also much at the level of interventions other than just, blocking the purchases of some of those firms in robotics or AI, which is you have done in Germany by foreign investors. If you really take seriously what I've said before, you're going to have SoftBank with a second fund of $200 billion, which is going to buy up every single researcher working on AI, of which we already have a shortage, and it's going to buy every single startup working on AI. Right? None of them have a connection to Europe. None of them have a connection to European Commission and so forth. Right? That's the reality that we are facing in Europe. And I think if that continues like this, our possible future is being able to pit the Chinese firms against the American ones, which for some time might be a comfortable position to be in. But ultimately, it's a future where we lost the most robust and the most important key infrastructure of the future. Right? And this is where I think we really need to start experimenting with ways in which we can have a different system for owning data. We can have a different way in which we do not just own data differently, but we do something with that data differently. That has to be tied to a national strategy for developing artificial intelligence based on that data. And it has to be tied to an understanding that the more that we allow those firms in, none of those are European firms, as I've said, those are all either Chinese or American ones, mostly American ones. The more we let those firms in, if we don't pay close attention to the contracts that our own public services and agencies and municipalities sign with them, the more data we will surrender to them. So it will become even harder to do anything about it. And unfortunately, given where we are right now, with a lot of municipalities and cities and public agencies and governments being broke, I'm not talking about Germany, I'm talking about, look at the Netherlands, look at the UK, look at Italy, look at Spain. For them, that is the solution. For them, it is the solution that allows them to reconcile the fact that they're broke with the fact that ultimately, they need to offer some services to their citizens. So in wrapping up, and I see the subtle hint approaching me on the right, in wrapping up, I would just like to say that, again, if you want to understand digital capitalism and who owns it, I would caution against situating it of the story of traditional capitalism, which itself became heavily globalized and heavily financialized. I haven't even touched some of the most important issues like the free flow of data, which is what allowed Americans to gather a lot of this data and build their AI systems, which is clearly linked to trade. I didn't have time to go there. But without having that broader historical narrative, and without being able to understand how value in this new economy is generated, and without understanding how data is key to the generation of that value, I don't think that we have much of a chance of resisting the challenges that are posed both by financialized capitalism and by its digital extension. Thank you so much.